Welcome to our deep dive on HYSA versus investing. In this video, we will explore why many young savers may be saving too safely and unintentionally losing long-term wealth. We will clarify the primary role of a high-yield savings account, compare it to diversified investing, and provide a practical framework for allocating your money. We will also include diagrams, examples, and quick quizzes to cement your understanding. Let's start by outlining the agenda so you know exactly what to expect. Here is the agenda. First, we will present a quick disclaimer. Next, we will define the trade-off between safety and growth. Then, we will demystify HYSAs and clarify their actual purpose. After that, we will explain diversification using ETFs and index funds. Subsequently, we will demonstrate the Rule of 72 and discuss time horizons. Then, we will provide a step-by-step action plan and show an allocation flow. Finally, we will wrap up with key takeaways and quiz questions to check your understanding. Before we begin, please note this video is for educational purposes only and does not constitute financial advice. Investing involves risk, including the possible loss of principal. You should consider your personal circumstances and, if needed, consult a qualified financial professional. With that out of the way, let's transition into the core framework: safety versus growth. The fundamental decision for young savers is whether to prioritize safety or growth. In other words, safety preserves your capital, while growth aims to compound it. To make consistent progress, we must align our choices with time horizon and risk tolerance. Next, let's clarify what a high-yield savings account actually does and does not do. A high-yield savings account is designed for capital preservation rather than appreciation. Its primary job is to hold your emergency fund, typically 6 to 12 months of living expenses, and to keep short-term goals safe and liquid. This prevents you from borrowing at high interest rates when emergencies arise. However, because savings rates often lag long-term inflation and market returns, HYSAs are not engines of wealth creation. Therefore, once your emergency buffer is funded, it is prudent to direct additional funds to growth assets, especially for goals with a time horizon longer than 5 years. Now that we have defined safety, let us compare it to investing for growth. On the left, HYSAs offer liquidity and stability, which protects you from needing to borrow at high rates. However, they typically provide limited growth and can suffer from inflation drag. Consequently, they are best suited for emergencies and short-term goals. On the right, diversified investing, especially through broad market ETFs or index funds, historically delivers higher returns, though it includes volatility and periodic drawdowns. Therefore, investing is better aligned with long-term goals exceeding 5 years. With this comparison in mind, we can map a clear allocation flow. This flowchart begins with calculating your monthly expenses, then multiplies by 6 to 12 to establish your emergency fund target. Next, you build your HYSA until that target is met. If your goal's time horizon is less than 5 years, keep funds in HYSA or other short-term, low-volatility instruments. Otherwise, invest the surplus into a diversified mix of broad market ETFs, preferably through dollar-cost averaging. Periodically, you rebalance to maintain your target allocation and continue the process over time. Diversification through broad market ETFs allows you to own hundreds, sometimes thousands, of companies in a single fund. This reduces the risk associated with any single company and leverages overall market growth. Low-cost index funds often outperform a majority of actively managed funds over long periods due to lower fees and consistency. Automating contributions with dollar-cost averaging reduces the impact of short-term volatility. Moreover, remaining invested over time generally matters more than trying to time market entries and exits. This pie chart illustrates an example allocation after you fully fund your emergency buffer. For instance, 20% might remain in cash for liquidity, while 80% goes into diversified investments for growth. However, the actual split varies based on your risk tolerance, income stability, and goals. The key takeaway is to protect your base with an adequate buffer and then maximize growth exposure for long-term objectives. This table uses the Rule of 72 to approximate how long it takes your money to double at various annual returns. You divide 72 by the expected annual rate of return. For example, at 8%, money doubles in about 9 years. At 6%, roughly 12 years. and at 4%, approximately 18 years. While this is a rule of thumb and not exact, it powerfully illustrates how compounding accelerates wealth growth over time. Next, we will present a Markdown explainer with examples. Here is a concise Markdown explanation. The rule of 72 estimates the years required for money to double by dividing 72 by the expected annual return. For instance, at 8% the estimate is 9 years, and at 10% it is approximately 7.2 years. However, this is only an approximation. Actual returns vary, and factors like fees, taxes, and investor behavior can reduce realized outcomes. Use this rule as an intuition tool rather than a precise forecast. Now, let us test your understanding with a quick quiz. Quiz time. The question is, what is the primary purpose of a high-yield savings account? Option A, to maximize long-term wealth growth. Option B, to fund short-term speculation. Option C, to preserve capital as a liquid emergency buffer. Option D, to replace diversified investing entirely. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. The primary purpose of a high-yield savings account is to preserve capital as a liquid emergency buffer. This helps you avoid borrowing at high interest rates when unexpected expenses occur. It is not designed to maximize long-term returns. Now that we have clarified the role of savings, let us construct a concrete action plan you can follow. Here is your action plan. First, calculate your monthly expenses, including housing, utilities, food, transportation, insurance, and debt payments. Next, target 6 to 12 months of those expenses in your high-yield savings account. Then, automate transfers to build this buffer consistently. If your investment horizon is greater than 5 years, invest the surplus into broad market ETFs or index funds. Use dollar-cost averaging and strive to minimize fees. Periodically rebalance your portfolio and resist the urge to time the market. Finally, review your plan annually as your income, goals, and risk tolerance evolve. To visualize the long-term journey, let us look at a timeline of compounding. This timeline illustrates how outcomes unfold over multiple years. Initially, you start investing while simultaneously completing your emergency fund and establishing dollar-cost averaging. Over years 4 through 7, you remain invested and reinvest dividends. During years 8 through 15, compounding becomes more noticeable. From years 16 through 25, larger market cycles occur, and rebalancing helps you stay aligned with your targets. Beyond year 26, the cumulative effect of time in the market becomes the dominant driver of wealth, despite intermittent volatility. Next, let us solidify the rule of 72 with one more quick question. Here is your second quiz question. Using the rule of 72, approximately how many years does it take to double your money at an 8% annual return? Option A, 6 years. Option B, 9 years. Option C, 12 years. Option D, 18 years. You may pause the video now to consider your answer. We will discuss the answer in the next section of the video. The correct answer is B, 9 years. This comes from dividing 72 by 8, which equals 9. This simple calculation demonstrates how time and compounding can accelerate growth over long horizons. Now let us lock in the most important takeaways from today's session. These are the key takeaways. First, high-yield savings accounts preserve capital, while investing seeks growth. Second, fully fund your emergency savings before channeling surplus into long-term investments. Third, diversification, low costs, and time in the market form a powerful combination. Fourth, the rule of 72 provides quick intuition about compounding. Finally, time is your greatest asset, so starting early is advantageous. Next, we will summarize and wrap up. To summarize, build 6 to 12 months of expenses in a high-yield savings account to protect your downside. Then, invest surplus funds for goals beyond 5 years using diversified ETFs. Employ dollar-cost averaging, rebalance periodically, and avoid market timing. Remember the rule of 72 as a quick mental model for growth. Above all, let compounding work on your behalf by starting early and staying consistent. Finally, let us conclude with a closing message. Thank you for watching. If you found value in this video, please like, share, and subscribe for more. In addition, tell us your current HYSA versus investing split and your long-term goals in the comments. Your insights might help someone else take their next step.